Hello, I'm Kathy Sager. I'm a senior financial advisor with CG Wealth Management. And today I'm lucky to have Kevin Vandermeer with us. So Kevin is the lead portfolio manager for the investment team for CG Wealth Management. Prior to joining CG Wealth Management in 2017, Kevin managed approximately $4 billion for the Royal Bank. And he's won numerous awards, including the Lipper Fund Award for Outstanding Performance. He attended University of Toronto, where he graduated with honors. And then he went on to earn a CFA, Chartered Financial Analyst, and he is a fellow of the Canadian Securities Institute. So thank you for joining us today, Kevin.
Thank you. Thank you for having me. It's an honor to be here and talk about some of the issues we're all facing in the market.
Which is a challenging time, as always, in the market. But we do have a few specific questions, if you don't mind.
Yeah.
And the first thing we're thinking, top of mind, is inflation. And high inflation came to us as a result of loose monetary policy from the Federal Reserve after the pandemic. Now, fighting this inflation has been a focal point for the Federal Reserve. How do you think they're doing?
Well, great question. I know that anybody that has bought anything recently, or if you've been out, in restaurants, we've all been sort of surprised by the increases in prices, whether it's in food or anything we're buying. So if we flip through, we've got a couple of slides, and we want to show you a couple of things. If we flip through to the next slide. Talk about inflation particularly. So before we sort of think about what the Federal Reserve is doing, we want to show you kind of where we've been. So obviously through the pandemic, a lot of money was put into the system, and as a result, kind of inflation went to as high as 9.1% on a year-over-year basis. Luckily, that has started to come down, and so in April, we saw that coming down to kind of 4.9. So directionally, I think the worst is behind us. Directionally, it's going down. And as many of you know, the Federal Reserve is targeting a 2% inflation rate. So, the job isn't done just yet, but we're definitely going in the right direction. If we flip to the next slide, one of the big components inside of CPI, or the Consumer Price Index, are rents, or where we live. And one of the reasons why inflation has come down so much is because rents have come down. And now we're looking at US data here, but the same is true for Canada. And we tend to focus on the US market because it is so big, and roughly half of the world's wealth is domiciled in the US. Another big component of inflation, if we flip to the next slide, is wages. And we've seen wages start to come down as well. So that puts kind of pressure on inflation if people are demanding wage increases, whether they're moving to get a new job and get paid more, or if they're staying at a job and asking for a raise. That seems to have peaked again back in June of last year. So all of those suggest that the worst is behind us, and inflation is coming down, which means, I think you're going to ask me a little bit about interest rates, but I think the worst is behind us in terms of inflation.
So as part of their plan to reduce inflation, the Federal Reserve has been increasing interest rates for well over a year now. When do you expect these rate hikes will end?
Great question. So let's flip to some slides that I have here. So typically, the Federal Reserve and Canada, the Bank of Canada, similarly, tends to stop increasing rates when the cost of funds or interest rates matches or equals CPI or inflation. And we're roughly there now. Interest rates, or the Fed funds rate, is kind of 5% to 5.25. So 5%. And as I showed you earlier, CPI is roughly 4.9 and 5%. So we're kind of the worst in terms of rate increases. And, if anybody's got a variable mortgage or any kind of lines of credit, you've definitely felt the impact of increased interest rates. But it looks like we're kind of towards the end, and we're kind of anticipating that at the next meeting, the Federal Reserve will pause. I've got another slide here that just kind of shows you where the Fed's fund rate is, which is around 5%, and we saw CPI. But I think the next slide is more interesting, and I won't get into the kind of the dynamics and all of the math behind this slide, but really what this slide is showing is that people are betting that there's a 50% chance that the Fed pauses in their June 14th meeting. So this is sort of investors and speculators can bet on interest rate movements. And right now, there's a 50% chance right now that they think they're going to pause. So that's kind of our view on interest rates and the market's view on interest rates.
Interesting. So as far as earnings, Kevin, we're coming out of the busy earnings season for the first quarter of 2023. What did you see from some of the big companies that have already reported earnings?
Yeah, so again, great question. So we're just about through earnings season right now, Q1 earnings. And I'm sure that you've all heard and all read about, this recession that's coming, whether it's a hard landing or a soft landing. A hard landing obviously would be one where earnings are down a lot, people are laying off, there's just a tough time. A soft landing is something a little more manageable and subtle. And one of the best ways to kind of determine whether it's a hard landing or a soft landing is looking at what are the earnings of companies, and more specifically, what are companies saying about business, the operating environment of the business, and the kind of guidance they're giving. And really, what we saw is that earnings are pretty good right now. They're coming in, about 70% or 76% of companies that are reporting are actually beating analyst estimates. And so this is really good news for kind of the overall market and the economy in general. So as much as you're hearing in the news about a recession, when you look at what companies are saying and what they're actually reporting, the numbers are fairly strong. I think I've got another slide here. Oh, okay. I think you're going to ask me another question.
We're more interested, not that we're not interested in earnings, but we are interested in all the talk we've heard about the regional banking crisis. And I don't know if crisis is really the right term or not, but we did have some problems with smaller and larger regional banks in the United States. And so we're wondering if that issue will affect the equity markets on a go-forward basis.
Yeah, another great question. So yeah, we had some bank failures or rescues in the US, and these were not necessarily small banks. In one case, it was the 15th largest bank in the US, and ultimately the regulator as well as the government stepped in and helped facilitate an acquisition. We also had a couple months ago 2 European banks merge. It happened very quickly over the weekend, but that and again, the reasons for that are sort of beyond the scope of this webcast. But for the most part, it looks like the worst is behind us again. I have a chart here that shows you maybe we'll just go back one slide here. It just shows you how the S&P has done. The S&P is in the blue line, shows you how the market has performed, sort of gone sideways and a little bit up. And then the orange line here shows how the banking sector has really come under pressure. And again, this is a U.S. regional bank where the issues were domiciled. The Canadian banks haven't fallen as much, but have definitely been impacted. And as you know, many of the Canadian banks have subsidiaries or business operations in the U.S. TD, for all intents and purposes, gets more of their earnings out of the U.S. So they're really a U.S. bank that is headquartered in Canada now. So these issues do affect our Canadian banks, obviously well capitalized, but we really feel that the worst is behind us. And if we go to the next slide, the market, these shares, what we're looking at is a composite. So I think there's maybe 20 or 25 small regional banks inside of this index. So it's a great way to kind of see what's going on the overall sector. And what we see is that kind of in late April, early May was sort of the bottom, call it maximum pessimism. And since then we're maybe up 10% from the bottom. So we don't expect contagion. That's a word that comes out, that's spread across the financial industry. We really feel like, again, the worst is behind us, and it's sort of being borne out in the share price.
Thank you. So 2023, we've seen strong performance, relatively strong performance so far this year for equities, with the S&P up over 8% despite fears of a recession. Now, what have you seen in terms of performance by the key indices so far this year?
Yeah, great question. So this slide here just kind of walks you through kind of the big, some of the bigger indexes. It's interesting, if you were to read the media, you would think that the market was down, maybe 10 or 15%. Again, all of this talk around recession, but in fact, the NASDAQ, which is obviously heavily weighted to large technology companies like Apple, like Microsoft, like NVIDIA, who reported earlier this week, Salesforce. There's some very, very large technology companies, and that's really where the strength has been this year. You can see that the NASDAQ's up almost 18%. And then the S&P and TSX, S&P is up 8%, and the TSX is up, kind of 6.5%. So as much as we've had to absorb high inflation, we've had to absorb rising interest rates, we've had to absorb talk of a recession, we've absorbed, a U.S. regional banking crisis. The market, despite all of this, is up. And in an average year, the market tends to be up about 7 or 8%. So we have certainly absorbed a lot and continue to do okay. The biggest issue before us today is the debt ceiling, whether politicians will approve that. And we really see that as a potential catalyst. If we flip to the next slide, before I talk about the debt ceiling, I just wanted to highlight again how concentrated the returns have been. So, and this is actually a very, very unusual, where you would have kind of 8 to 10 of the largest stocks generating most of the performance. So, as you look at your statements and look at the returns, most of the stocks in the S&P 500 are flat year to date.
Right.
And about I read somewhere, I think this morning even, that more than 100% of the return can be found in, the companies that you're looking at here, the Apples, the Microsofts, the Googles, the Amazons, the NVIDIA. NVIDIA, if you don't know, is a large chip maker. They build these really fast chips, and they're really benefiting from this whole trend in the artificial intelligence space. The guidance that they gave was really strong, so that's why it's up so much year to date. Berkshire Hathaway, which is Warren Buffett's company, sort of flat, but his largest position is actually Apple, so he's benefiting from Apple. Meta is the old Facebook, again, really beaten down last year, up 110%. They actually announced layoffs this week, more layoffs. The market perceives that as being positive because they're taking costs out. Again, the market has been really narrow. So as much as we look at the market and say the market's up, your portfolios may actually be flat unless you own positions in these companies. Maybe we'll just flip to the next slide. So things that we're looking at and things that maybe aren't necessarily evident to investors is that the markets actually hasn't done anything in a year, which is rather unusual. If you go back to kind of May of last year, you could see on both the TSX and the S&P, we've been bouncing around these resistance levels, we call them. So in the S&P 500, 4,200 or 4,200 has been a level where the market hasn't been able to break above. And the same with the TSX. The index is slightly different, but TSX it's 22,100 or 2,100 is the level that the market just has not been able to get above. Some things that we're looking at and reasons why we think that we're positive on the back half of the year is, I referenced it earlier, is the debt ceiling.
Right.
We're kind of 1 week out right now. And there's no way that the US government will default on its debt. It just will not. What you need to understand is that it's being controlled by politicians. They will take the debt ceiling to the last hour. They will drag this out. It will be bumpy next week because there's going to be all kinds of rhetoric. People will leave the room. They'll make it sound like it's never going to happen. You should expect the market probably to sell off. And then at the last minute, they'll get it done because they will not default on their debt. And I think that is the catalyst that begins. The market doesn't like uncertainty, doesn't like unknowns. Once that's settled, and everybody knows the government's not going to run out of money, I think all of these bigger issues that we've talked about, are kind of behind us. And I think the market goes higher. And then the last slide, I think on my presentation today is there's an incredible amount of cash on the sidelines. And I think once the market has clarity, this cash will start to work its way back into the market. And when this cash starts to move in, it'll move into high quality companies, high quality stocks. And this is another catalyst for the market to move higher as we see it.
Yeah, the market needs money, and there's a lot that I can see. The slide that was one back, if we just return to that for a sec, in other markets, other bear market endings, because I've been doing this a long time, and this is certainly not the first bear market we've been through. It usually ends like that, where you have a sideways move, technically speaking. You have a resistance, which I think you've pointed out is around 4,200. And then you have a support level, I think around maybe 3,700.
Yep.
And it could just base like that for a while. And then there will be a catalyst that will cause it to break out. And maybe what you're talking about with all the extra cash on the sidelines and reaching a consensus on the debt ceiling, that's something that we could see in the back end of this year. Do you agree with that?
Yeah. And then I think the other thing that could be a catalyst is historically, when the Federal Reserve, and we talked about this earlier, when the Federal Reserve pauses, so stops raising interest rates.
Right.
Historically, and every time is different, but historically, they will cut about 4 to 6 months after.
Right.
So if the Federal Reserve pauses on the June meeting, you could actually make a case that they might cut in Q4 of this year, if history is our guide.
Q4, maybe next year, Q1, somewhere in.
Yeah.
And the market, of course, being a leading indicator, will look ahead to that.
Yeah.
So we would see hopefully positive market action 4 to 6 months prior to the actual cut.
Yeah, which would put us kind of in right now.
Yeah, kind of like really soon. So fingers
Yeah.
crossed for really soon. And we sure appreciate your time and your knowledge. And thank you so much. Maybe you
Thank
could spend 1 minute with us, one further minute, discussing what portfolios you manage that our clients could have access to.
Sure. Yeah. So let me talk a little bit about those. We'll flip to the next slide. We have a number of products, and what I would say is, speak to Kathy. Kathy will know your situation, your particular financial goals, your risks. Kathy has been in the industry for many, many years, is an incredible professional, has been recognized, by the Globe and Mail and others. So, as we share kind of investments, it's very important to just consult with Kathy and make sure that, the investments that are suitable to you. But we have a number of them. One of them is what we would call a global balance product. So this gives you exposure to Canada, US, Europe, emerging markets, will give you exposure to global infrastructure, global REITs. And depending on how risk or how much risk you want to take, you can have a very conservative portfolio that would give you 60% fixed income and 40% equity, or something more aggressive that would be 80% equity and 20% fixed income. And you can see the returns year to date, kind of we're at 5 or 6%. Obviously rates that are returns that are higher are taking more risk. And historically, the returns on these portfolios have done very well. You can see the inception numbers kind of at the end here, at the far right of the slide here. If we go to the next slide, this is a very busy slide, but it again makes the point that it's really well diversified. So this is our most diversified product. You can see on the far left, we have Canadian equities, global equities, which is primarily US. Again, emerging markets, EM is emerging markets. We have small cap exposure, real estate, infrastructure, and then we have bonds. We have, both corporate bonds, government bonds, and then high yield bonds, which will give you a higher coupon, but again, a little bit more risky. So that's really well diversified. And then again, depending on your risk tolerance, and Kathy is the expert there in terms of determining, you'll agree with her on the type of risk that you want to take. If we flip to the next slide, another product that we manage is our North American equity, which gives you a combination of both Canada and the US. If you flip to the next slide here, I think we have the holdings. So this portfolio, which has about 50 names in it, would give you exposure to the very best in North America. So you can see in the energy patch, you'd have Exxon, you'd have Exxon, obviously the US largest global producer of energy. But then you also have Suncor, you have Enbridge,
NVIDIA.
We do have NVIDIA.
It's a big day today. Yeah, big day for NVIDIA today.
Yeah. Thankfully, we do have NVIDIA in the portfolio, but you also have Microsoft and Apple.
Yep.
We have Google. We have Amazon. So you again have, and these have been in the portfolio a while. So these are not, these have been benefiting from, the start of the year. The one that we don't have is Tesla. That's done well. We have owned Berkshire Hathaway in the past, but we don't own it currently. But you can see we have good exposure to insurance companies. So this is just a really nice diversified portfolio across all sectors, and it's a North American. It gives you North American exposure to some of the very best. We've got rails, we've got telephone, we've got BCE, we've got kind of utilities. So those are just kind of two products, one global and one kind of North American. One you would use ETFs in and the other individual stocks. But again, I will defer to Kathy on the product that's best for you. She will spend the time and really understand your needs and the financial goals that you're trying to meet.
Thank you, Kevin. We're excited for your new product as well. The Global Leaders Fund of Funds.
Yes, yeah.
We're excited about that. Yeah.
Yeah, that
I know it's too new for you to have a slide for it because it's just like this week. But
yeah, we'll do it. We can do another webcast
next time we'll talk about that.
Yeah, we're super excited about that. And
Yeah.
you know,
The
there was a
performance.
large team that was part of that, and many of them are on this call that really contributed to that. And I think that's exciting too. We can easily do a call on that as well.
Well, and it's nice because my clients know that we chat every 30 or 90 days, depending. But this is nice because you will manage and change things as you see fit. So if you need to change something, they don't need to talk to me, or, you know, it's just automatically rebalanced for them. And I think that takes it's a sense of relief for people that they know that you're watching on a daily basis.
Yeah,
And
we do, and we usually rebalance monthly, so we're definitely always watching. And
you're on it, which
Yeah.
is much appreciated, and so is your time. So thank you, and we will look forward to our next chat.
Good.
And we'll have the auto rebalancing. You can visit us at sagerfinancialgroup.com, and we'll have more on our website about Kevin's products and portfolios that you can access as well. So look forward to hearing from you, and thanks so much, Kevin.
Thank you.
Bye.
Bye now.